It always starts the same way: people think is manageable until suddenly it isn't. Stanley Druckenmiller has spent decades watching cycles turn, and if there's one thing he understands better than most, it's how quickly confidence can flip into crisis. In 2026, the real question isn't whether debt matters, it's whether you're positioned on the right side of it. Do you use it, invest through it, let inflation quietly erode it, or do you play defense and get out clean? Because when the tide shifts, and it always does, the difference between those choices isn't theoretical, it's everything. What most people underestimate is how dramatically the environment changes when interest rates stop falling and instead stay elevated for longer than expected. For years, cheap money created a kind of illusion. Borrowing felt almost harmless, even strategic. Mortgages, business loans, margin accounts, all of it made sense when the cost of capital was low and predictable. But when rates rise and refuse to come back down, the entire equation shifts, and it does so in a way that catches people off guard. Higher rates don't just increase payments, they change behavior. Consumers pull back because servicing debt takes a larger share of income. Businesses hesitate because expansion becomes more expensive. Investors, who once chased growth at any cost, suddenly start demanding profitability and cash flow. That shift ripples through the system, quietly at first, then all at once. What looks sustainable under one set of assumptions begins to crack under another. The real danger isn't the initial rate hike, it's the persistence. When people believe rates will fall soon, they tolerate the pressure. They refinance later, they wait it out. They assume relief is coming. But when that relief doesn't arrive, when rates remain higher quarter after quarter, year after year, the strain compounds. Adjustable rate loans reset, refinancing windows close. Debt that once felt temporary becomes a long-term burden. This is where the trap begins to form. It's not about taking on too much debt in a vacuum, it's about taking on debt under the wrong expectations. If your entire strategy depends on lower rates in the future, you're effectively making a macro bet. And when that bet goes wrong, the consequences aren't theoretical, they show up in cash flow, in missed opportunities, in forced decisions. You start to see it in the margins. Companies that once expanded aggressively begin cutting costs, hiring slows, then stops. Projects get shelved, not because the ideas are bad, but because the cost of funding them no longer makes sense. Households feel it too. Discretionary spending tightens. Savings rates fluctuate unpredictably. The economy doesn't collapse overnight, it constricts gradually, like a tightening vice. What makes this environment particularly unforgiving is that it exposes weak balance sheets. When money was cheap, inefficiency could hide. Poor capital allocation didn't matter as much. Debt could be rolled over, extended, managed. But with higher rates, that margin for error disappears. Every dollar of debt demands more in return, and if the return isn't there, the pressure builds quickly. At the same time, asset prices begin to reflect this new reality. Valuations that were justified under low-rate assumptions start to compress. The math is simple but brutal. Higher discount rates mean lower present values. Stocks, real estate, even private investments all feel the effect. And when asset prices fall while debt remains fixed, the balance becomes even more fragile. There's also a psychological component that's easy to overlook. For over a decade, many participants in the market operated in a regime where central banks were quick to step in, quick to cut rates, quick to provide liquidity. That created a kind of conditioned response, a belief that downside would always be limited. But in a higher, for longer environment, that safety net feels less certain. The reactions change, risk tolerance shrinks, decisions become more defensive, and that's when second-order effects start to emerge. Credit conditions tighten not just because rates are high, but because lenders become cautious. They reassess risk. They demand better terms, more collateral, stronger financials. Access to capital becomes selective. For those who need it most, it becomes hardest to obtain. All of this feeds back into the core issue, debt servicing. It's no longer just about whether you can make payments today, but whether you can sustain them under prolonged pressure. A small increase in rates might seem manageable, but over time it compounds. It eats into flexibility, it limits options, it forces trade-offs that wouldn't exist in a lower rate world. And the reality is, most people don't adjust quickly enough. They anchor to the past, they expect conditions to revert. They delay difficult decisions, hoping for a more favorable environment. But markets don't operate on hope, they respond to reality. And when that reality is higher rates for longer, the cost of waiting can become significant. And just as that pressure builds beneath the surface, something else begins to take control: liquidity. And not earnings, not valuations, not even long-term fundamentals in the way most people think about them. In the short term, what really moves markets is the availability of money, how easily it flows, and how quickly it can be deployed or withdrawn. It's a force that doesn't always announce itself clearly, but when it shifts, everything else tends to follow. You can have strong companies, solid balance sheets, and compelling growth stories, but if liquidity is tightening, those factors take a back seat. Prices don't move based on what something's worth in theory. They move based on who is willing and able to buy. When capital is abundant, buyers step in aggressively. Risk at multiples stretch. Assets get bid up beyond what traditional metrics would justify. It feels like confirmation that the story is right, but often it's just the effect of excess liquidity searching for a home. Then the environment changes, central banks pull back, credit becomes more expensive. Money that once flowed freely starts to slow, then stall. The same assets that rose effortlessly begin to struggle, not necessarily because their fundamentals deteriorated overnight, but because the marginal buyer disappears. And without that buyer, prices have nowhere to go but down or sideways. This is where many get caught off guard. They analyze earnings reports, study industry trends, and build detailed models. But they underestimate the role liquidity plays in amplifying or suppressing those factors. In a tightening environment, even good news can fail to move prices higher. The market becomes less responsive to positives and more sensitive to negatives. It's not logical in the traditional sense, but it's consistent with how capital flows behave under constraint. Liquidity also affects volatility in ways that aren't immediately obvious. When there's plenty of it, markets can absorb shocks. A sudden sell-off finds buyers quickly. Dips get bought, confidence remains intact. But when liquidity is thin, those same shocks can cascade. Selling leads to more selling, stops get triggered. Margin calls force liquidations. What might have been a contained move in a different environment turns into a sharp, disorderly decline. At the institutional level, this dynamic becomes even more pronounced. Large funds don't just react to fundamentals, they react to flows. Redemptions force them to sell, regardless of their long-term view. Inflows push them to deploy capital, sometimes at less than ideal prices. The result is a feedback loop where price movements are driven as much by positioning and liquidity needs as by underlying value. There's also the role of leverage, which ties directly into liquidity. When borrowing is easy and cheap, leverage expands. Investors take larger positions, hedge funds increase exposure, and the system becomes more interconnected. That works well on the way up. But when liquidity tightens, that same leverage becomes a source of instability. Positions need to be reduced. Risk needs to be managed. And that often means selling into weakness, which accelerates the move. Retail investors feel this too. Even if they don't always recognize it, the ease of access to capital through margin accounts, low-interest loans, or even just rising asset values creates a sense of confidence. It encourages participation, risk-taking, and a belief that opportunities are everywhere. But when liquidity contracts, that environment reverses. Access becomes limited, confidence fades, participation drops. What makes liquidity so powerful is that it operates across all asset classes simultaneously. It's not confined to stocks or bonds or real estate. It influences everything. When liquidity is expanding, correlations tend to rise as assets move up together. When it contracts, those same correlations can work in reverse, with multiple asset classes declining at the same time. And yet, it's one of the least visible forces for most participants. It doesn't show up clearly in a single data point. It's reflected in a combination of interest rates, credit conditions, central bank policies, and market behavior. Understanding it requires looking beyond the surface, beyond the narratives, and focusing on the underlying flows. Because in the end, markets are not just mechanisms for pricing value, they're systems for allocating capital. And when the availability of that capital changes, the outcomes change with it, often in ways that defy conventional analysis and catch even experienced participants off balance. And while liquidity dictates the rhythm of markets in the short run, there's another force working more quietly in the background, one that doesn't shock you all at once but instead reshapes outcomes over time. Inflation. Not the headline number people glance at once a month, but the persistent erosion of purchasing power that changes the real value of everything, especially debt. At first glance, inflation feels like a problem. Prices rise, expenses increase, and the immediate reaction is defensive. People worry about how far their income will stretch, how much more they'll need just to maintain the same standard of living. But when debt is part of the equation, inflation introduces a strange kind of duality. It can hurt you on one side while helping you on the other, and most people fail to recognize both effects at the same time. Debt, by its nature, is fixed in nominal terms. You borrow a certain amount, and unless it's variable rate, the principal doesn't change. What does change is the value of the currency you repay it with. If inflation is high and sustained, the money used to pay back that debt becomes less valuable over time. In real terms, you're paying back less than you borrowed. That's the hidden mechanism through which inflation can quietly reduce the burden of debt. But it doesn't work in isolation. The benefit only materializes under specific conditions, and those conditions are where things get complicated. If your income rises alongside inflation, if your cash flow adjusts upward, then servicing debt becomes easier in real terms. Wages increase, revenues grow, and the fixed obligations shrink relative to your earnings. It feels like the system is working in your favor. However, if inflation rises without a corresponding increase in income, the situation flips. Your expenses go up, your purchasing power declines, and even though your debt is technically being eroded in real terms, your ability to service it becomes more strained. The theoretical benefit gets overshadowed by practical pressure. You're still making the same nominal payments, but they now represent a larger share of what you can actually afford. This is where timing and structure start to matter in a way most people overlook. Fixed rate debt behaves very differently from variable rate debt in an inflationary environment. With fixed rates, inflation can be an ally over time. With variable rates, the cost of borrowing can rise alongside inflation, offsetting or even eliminating any advantage. What seemed like a smart decision in one regime becomes a liability in another. There's also the interaction between inflation and asset values. In many cases, inflation pushes nominal asset prices higher. Real estate, equities, commodities, all can benefit as the value of money declines. If you hold assets that appreciate with or ahead of inflation while your debt remains fixed, the balance tilts further in your favor. Your assets grow, your liabilities shrink in real terms, and the gap between them widens. But that relationship isn't guaranteed. Inflation can also lead to tighter monetary policy, higher interest rates, and reduced liquidity, all of which can suppress asset prices. So while inflation might be eroding your debt, it could simultaneously be putting pressure on the very assets you're relying on to offset that debt. The outcome depends on which force dominates and how long each persists. Another layer to consider is expectations. Inflation isn't just about what is happening, it's about what people believe will happen. If inflation is expected to remain high, behavior adjusts. Lenders demand higher interest rates to compensate. Borrowers become more cautious. Contracts get structured differently. The system adapts. And the initial advantage of inflation begins to diminish as those expectations get priced in. For those who understand this dynamic, inflation becomes less of a binary threat and more of a variable to navigate. It's not simply good or bad, it's conditional. It can work for you if your positioning aligns with it, or against you if it doesn't. The challenge is that those conditions are constantly shifting, influenced by policy decisions, market reactions, and broader economic trends. And in that shifting landscape, the real risk isn't inflation itself. It's misunderstanding how it interacts with your specific situation, assuming it will help without considering income growth, debt structure, or asset behavior can lead to false confidence. At the same time, fearing it without recognizing its potential benefits can lead to overly conservative decisions that miss opportunities. So while inflation operates in the background, its effects are anything but minor. It changes the real value of money, the real burden of debt, and the real returns on investment, often in ways that aren't immediately visible but become undeniable over time as the numbers adjust and the gap between nominal perception and real outcome continues to widen. And once you start seeing how these forces interact, the conversation shifts away from what should work in theory to what actually works in practice. Because in environments like this, timing stops being a secondary consideration and becomes the defining factor. You can be directionally right about inflation, about rates, about liquidity, and still lose if your timing is off. This is where most strategies begin to break down. On paper, investing while carrying debt can make perfect sense, especially if expected returns exceed borrowing costs. The math looks clean, almost obvious. But markets don't move in straight lines, and they rarely align with neat projections. Returns don't arrive on schedule, and costs don't always stay where you expect them to. That gap between expectation and reality is where timing exerts its influence. Consider what happens when you invest aggressively at the wrong moment. You might be correct about the long-term trajectory, but if the market moves against you in the short term, if liquidity tightens, if sentiment shifts, if valuations compress, you're immediately under pressure. Losses mount, confidence drops, and the presence of debt amplifies the stress. You're no longer just waiting for a recovery, you're managing obligations in real time. On the other hand, paying down debt aggressively at the wrong moment carries its own cost. If you allocate capital to reduce liabilities just before a strong market upswing, you miss out on potential gains. The opportunity cost can be especially in environments where returns are concentrated in short bursts. Timing, in this sense, isn't just about avoiding losses, it's about capturing the moments that matter most. What complicates this further is that timing isn't purely about entry and exit points. It's about aligning your decisions with the broader cycle. Where are you in the interest rate cycle, in the liquidity cycle, in the inflation cycle? Each of these layers influences the effectiveness of your choices, and they don't always move in sync. You can have rising rates alongside strong assets or falling rates alongside weak growth. The combinations are endless, and each one demands a different approach. This is why rigid strategies tend to fail. A fixed rule, always invest, always deleverage, always hold, ignores the variability of the environment. It assumes that conditions will behave in a predictable way, when in reality they rarely do. Timing requires flexibility, the willingness to adjust as new information emerges, and the discipline to act even when it feels uncomfortable. There's also the issue of sequencing, which often gets overlooked. The order in which events occur can have a profound impact on outcomes. Two individuals with identical strategies can end up with completely different results simply because of when they started. One catches a favorable cycle, the other enters during a downturn. The difference isn't in their understanding, it's in their timing. And unlike theory, which operates in a controlled framework, real-world timing is messy. It involves uncertainty, incomplete information, and constant noise. Signals get mixed, indicators conflict. What looks like a turning point can turn out to be a false start. Acting too early can be just as costly as acting too late, and finding the balance between patience and decisiveness is where the real challenge lies. This is where experience begins to matter, not in the sense of predicting exact outcomes, but in recognizing patterns, understanding how different variables interact, and knowing when the risk-reward balance has shifted. It's less about precision and more about positioning, being broadly aligned with the prevailing forces rather than fighting against them. In the context of debt versus investing, timing becomes the bridge between these choices. It determines when leverage is an advantage and when it becomes a liability. It influences whether holding onto debt allows you to benefit from rising asset prices or exposes you to unnecessary risk. It shapes whether paying down debt provides stability or causes you to miss critical opportunities. And perhaps most importantly, timing introduces an element of humility. It reminds you that being right isn't enough. You have to be right at the right time. Markets don't reward ideas in isolation. They reward ideas that align with the moment. And that moment is constantly shifting, driven by forces that are often beyond any single participant's control, forcing decisions to be made not in certainty, but in the tension between what you believe and what the environment is actually delivering in real time. And when timing, liquidity, and inflation all collide, one factor quietly magnifies every decision you make: leverage. It's the accelerant in the system, the force that takes a good idea and turns it into a great outcome, or takes a manageable mistake and turns it into something far more damaging. On the surface, leverage feels like a tool for efficiency. It allows you to do more with less, to amplify exposure, to pursue opportunities that would otherwise be out of reach. But beneath that surface, it carries a sensitivity that most people don't fully appreciate until conditions shift. Leverage doesn't just increase potential returns, it compresses your margin for error. Without it, you can afford to be early, even a little wrong, and still recover over time. With it, the timeline shrinks. Movements that would have been tolerable become critical. A modest decline in asset value can translate into a significant hit to equity. The math becomes unforgiving, and the psychological pressure follows quickly behind. In a stable or rising environment, leverage can feel almost invisible. Gains accumulate faster, confidence builds, and the strategy appears validated. You start to believe that the system is working exactly as intended, that the additional risk is justified by the additional return. And for a while, that belief is reinforced by outcomes. But that's precisely what makes leverage so deceptive. It works best right before it doesn't. The transition is rarely gradual. It often begins with a subtle shift. Volatility increases, liquidity tightens, correlations change. Positions that once moved independently start moving together. Diversification loses some of its protective power. And because leverage amplifies exposure across all positions, the impact becomes more concentrated than expected. Losses that seem manageable in isolation begin to stack. This is where the mechanics of leverage start to take control. It's no longer just about your view on the market. It's about your ability to maintain positions under pressure. Margin requirements come into play. Lenders reassess risk. What was once a flexible structure becomes rigid. You're forced to make decisions not based on strategy, but on necessity, and necessity rarely aligns with optimal timing. Selling into weakness, reducing exposure at the worst possible moment, locking in losses that might have recovered given more time. These are the outcomes leverage can force. It removes optionality. It takes what could have been a temporary setback and turns it into a permanent result. At the same time, leverage doesn't operate in isolation from the broader environment. It interacts directly with interest rates, with liquidity, with volatility. When rates rise, the cost of maintaining leverage increases. When liquidity tightens, the availability of leverage decreases. When volatility spikes, the risk associated with leverage expands. Each of these factors compounds the others, creating a feedback loop that can accelerate both gains and losses. What makes this particularly challenging is that leverage often builds gradually. It's not always a conscious decision to take on significant risk. It can accumulate through small choices, slightly higher position sizes, slightly more borrowing, slightly more confidence in expected outcomes. Each step feels reasonable on its own, but collectively they create a structure that is far more sensitive than it appears. And because leverage amplifies outcomes, it also amplifies emotions. Gains feel more rewarding, reinforcing behavior. Losses feel more painful, prompting reactive decisions. The psychological impact can be just as significant as the financial one, influencing how you respond in critical moments. discipline becomes harder to maintain when the stakes are elevated. There's also an asymmetry that often gets overlooked. The upside from leverage is theoretically unlimited, but the downside is constrained by capital, and once that capital is impaired, recovery becomes exponentially more difficult. A significant drawdown requires disproportionately larger gains to return to the starting point. Leverage doesn't just increase the size of moves, it changes the path required to recover from them. In the context of debt and investing, leverage is the bridge between the two. Debt itself is a form of leverage, and how you use it determines whether it becomes a tool or a risk. Holding debt while investing is essentially a leverage position. Paying down debt is a form of deleveraging. The decision isn't just about returns, it's about how much sensitivity you're willing to introduce into your financial structure. And that sensitivity is what ultimately defines outcomes in uncertain environments. It dictates how much pressure you can do when conditions move against you, how much flexibility you retain when opportunities arise, and how resilient your position remains as the cycle continues to evolve in ways that are rarely predictable and never entirely under your control. And when all of these forces converge, rates staying higher, liquidity tightening, inflation shifting outcomes, timing becoming critical, leverage amplifying every move, the real danger isn't any single factor. It's being positioned for a world that no longer exists. Because the biggest losses rarely come from not knowing what's happening, they come from holding on to assumptions that have already stopped being true. Markets have a way of humbling conviction. What worked in one regime builds confidence, and that confidence slowly turns into certainty. Strategies become habits, habits become beliefs, and before long, those beliefs start to feel like facts. But the environment doesn't care about consistency. It changes sometimes gradually, sometimes all at once. And when it does, the same positioning that once delivered results can begin to erode them. This is where misalignment becomes costly. You might still be following a logical framework, still applying sound reasoning, but if that framework is built on outdated conditions, the outcomes won't match the expectations. It's like navigating with an old map. The structure is there, but the terrain has shifted. And the longer you rely on it, the further off course you drift. One of the clearest examples of this is how people respond to shifts in monetary policy. For years, markets operated under the assumption that central banks would step in at the first sign of trouble. That assumption shaped behavior. Risk-taking increased, leverage expanded, and downside protection became less of a priority. But when that assumption weakens, when support becomes less immediate or less predictable, the entire structure built on top of it starts to wobble. And yet, many continue to operate as if nothing has changed. They buy the same dips, hold the same exposures, and expect the same recoveries. It's not irrational, it's conditioned. It's based on a pattern that worked repeatedly in the past. But markets don't reward backward-looking thinking for long. Eventually, the gap between expectation and reality forces an adjustment. The challenge is that recognizing this shift in real time is incredibly difficult. There's always noise, always conflicting signals. Some indicators suggest continuity, others suggest change. Acting too quickly can mean abandoning a strategy that still has life in it. Acting too slowly can mean absorbing losses that could have been avoided. The balance between conviction and adaptability becomes the defining skill. Positioning, in this sense, isn't static, it's dynamic. It requires constant reassessment, not just of external conditions, but of your own assumptions. What are you implicitly betting on? Lower rates, higher asset prices, stable liquidity. If those assumptions are wrong, how exposed are you? These are the questions that often go unasked during stable periods, when outcomes are favorable and risks feel distant. But in shifting environments, those hidden assumptions come to the surface. They reveal themselves through performance, through stress, through the way positions react to unexpected changes. And once they're visible, they demand a response. Ignoring them doesn't make them disappear. It only increases their impact over time. There's also a tendency to focus on being right in absolute terms, rather than being aligned in relative terms. You can correctly identify a long-term trend and still suffer significant losses if your positioning doesn't account for the path it takes to get there. Markets rarely move in straight lines, and being early can look a lot like being wrong for longer than expected. This is why flexibility becomes more valuable than certainty. It allows you to adjust as conditions evolve, to reduce exposure when risks increase, and to re-engage when opportunities improve. It's not about abandoning conviction. It's about holding it loosely enough to adapt when the evidence changes. In the context of debt and investing, this misalignment can take many forms. Holding on to debt under the assumption that inflation will erode it, only to face rising rates and stagnant income. Investing aggressively under the belief that liquidity will remain abundant, only to encounter tightening conditions and declining valuations. Each scenario reflects a mismatch between expectation and reality, and the cost of that mismatch isn't just financial, it's strategic. It limits your ability to respond, to pivot, to take advantage of new opportunities as they arise. Because when you're positioned for the wrong environment, your focus shifts from growth to survival, from optimization to damage control, from making decisions proactively to reacting under pressure as the cycle continues to unfold in ways that rarely match the narratives people become most comfortable believing.